Good morning or good afternoon, depending on which side of the country you're joining us from. Thank you for spending some time to discuss some fun stuff today. We're all excited to have our annual industry update for planning and budgeting. We know it's full speed of budgeting season. Wanted to hop on a call with everyone here and chat a little bit about the things that we're seeing in the industry and get everyone prepared for budgeting and interest rates and whatever all happens for the next year. Today, I'm really excited to be joined by two incredible individuals that also enjoy red ties like myself. I'd like to thank Mr. Martin for joining us here. Dan, thank you for joining us, head of our transaction advisory services.
Yeah, thanks for having me, Charlie.
And also, as usual, Craig Cecilia, our Chief Investment Officer and Managing Director. Craig, thank you for being here.
Well, thanks for having me. Good afternoon and good morning, everybody. Thanks. Looking forward to a great webinar.
And do we look good in red ties? No, I look around at us. None of us have ties on. It's neat how that happens. So, but great to see everyone here. Thank you, gentlemen, for joining us. A couple housekeeping activities before we kick off. If you have any questions, go to the Q&A button and click on it, and then enter in your question. We'll answer them on the fly or at the end, whatever makes sense for you. So that's number one. Number two, if you'd like a copy of this webinar, I'd like to get it. It'll be on our website. You can also reach out to your MFA advisor to get a copy of it, as they're happy to provide you with a copy of that. And I do encourage you to reach out to your advisor to talk about this and what you should be doing to plan for next year. So without further ado, we're going to hop into some great stuff today. Really have 5 main points of the webinar: recession discussion, asset liability management, CECL discussion, investments, M&A, and projections, our great 2026 projections. As many of you know, you've heard this before, we are all lifelong learners here. We want to keep learning and getting better every day. Something really important, if you want to know about something, learn more about something, I'm sure we have a video on it on our website. Please reach out to your advisor if you don't know where it is on the website or if you don't see something you're looking for. But a lot of different webinars, we continue to constantly provide education to the industry. With that, I'm really excited too. Our MFA Navigator continues to grow exponentially. Our tech team has been doing amazing things with all of our functional groups here. And inside of our MFA Navigator, you can see all of our products and services and everything we do and all of your reports. Inside of the Navigator has all the investment activities, regular, alternative, and credit, our ALM reports, ALM simulations, liquidity, CECL, all those different areas, including budgeting, something super excited about. Also, our valuation area, a little bit it's on here, some of our MSR reports and QSO tracker, but great information that we have here on our website. So with that, I want to kick off and talk about scarcity value. Dan, anything you want to add to this chart here?
I think we have to thank Comerica and Fifth Third for their announced merger because, I think while there might not be a ton of opportunity in the state of Michigan, for example, consolidation certainly helps. I think there's 175 branches in Metro Detroit between Comerica and Fifth Third, so we should see some opportunity on that front in areas that we typically wouldn't.
Yeah, it's going to be difficult to grow this next couple of years. I think with population growth, in Michigan is one of the four slowest growing states in the country. As you look at the state that you're in, different population growth makes things better. But when you see a large bank merger like this, there's always fallout, and it's a great way to grow market share. But we continue to see the number of institutions shrink across the board, across the country, and the number of banks continue to shrink across the country. So you are more very, very valuable every day. The whole team here knows that I'm all in on AI. AI is all in misspelled, but I love this quote by the CEO of Walmart. It's very clear that AI is going to literally change every job. Maybe there's a job in the world that AI won't change, but I haven't thought of it yet. AI is definitely making a change. Some of the concerns I have about employment will be related back to AI. But it is definitely a big change in what's happening in decision making from lending to everything we do every day. So we want to keep that in mind. And the other piece of things is we coined this a year ago, or started using, I don't think we coined it, but I found this chart a year ago, the K-shaped economy, the haves and have-nots. And we say about 20% of the countries in the top end of the K curve, which is doing really well. Lots of money market deposits, low mortgage rates, own stocks, probably own a little NVIDIA, and they're really happy. But the other 80%, the not okay, are ones that are definitely struggling financially, food prices and all the other things that are happening right now. So definitely an interesting spot, which makes predicting the future different. I know all of us are going to have different opinions, but specifically all of us in this room, Dan, Craig, and myself, all have different opinions exactly where the economy is going, because there is such a disparity when you look at some of these unique situations. So we're going to give you our best expectations, but there's definitely a bit of things there that modify. Now, the question we're asked on a regular basis in planning for next year is, will there be a recession? And of course, I asked Gemini, my favorite AI agent at the moment, what's the best predictors for a recession? And Gemini gave me four things. One, an inverted yield curve, which has been spot on almost every time. Jobless claims rising, leading economic indicators being negative, and then increasing credit spreads. So if we look at these sections, it's really quite interesting to me. What we're seeing here is that we were in the longest inverted yield curve. And I know, Craig, it doesn't mean we have to have a recession, but typically following an inverted yield curve, we do have a recession, correct?
Typically we do, absolutely. Somewhere around that 12 to 18 months is what follows that inverted yield curve.
So now you could probably add, we've been uninverted for like 8 months right now, 10 months. Is that right? I'm trying to do the math in my head. I'm going to fail miserably, but
Yeah, somewhere in that range. But as long as we're eliminating overnight funds, right, and
yeah.
cash,
Yeah,
can't forget about the cash is king.
three month to 10 year. But yeah, it's definitely interesting, the inversion. It doesn't always follow through. It hasn't happened every time. It might not happen this time, but it is one of those things that is worrying for a technical chartist, that we've gone into this inverted yield curve now. And the last one that looked like this was 2006, 7, 8. But one of the things I want to be very clear with, us talking about a slowdown, us talking about a potential recession, whatever it may be, no expectations it'll look anything like 2005, 6, 7, 8. Very, very unique situation back then. So we're talking about just a mild downturn, if anything, going forward, if anything. Because I know, Craig, you don't agree with me 100% on that, and I want to make sure we talk about our differences of that opinion throughout this process. The second thing that Google Gemini told me, which I agree with, is then jobless claims. And if jobless claims are increasing, that we're going to see then potentially a recession or downturn, because amazing, if people don't have money to pay their bills, they don't pay their bills. And that's one of the things that takes place here. With that, it is quite interesting. If you look at this country right now, unemployment rate is rising in a few spots. The biggest one is Washington, D.C., which shouldn't surprise anyone, with all the government layoffs at 5.9%. We go over to California and Nevada, 5.4 each. And then we go to our wonderful state of Michigan at 5.3. And then we get into kind of Ohio, Kentucky, Illinois, the middle part of the country, kind of the Rust Belt. So that's where we're seeing unemployment increase, and it's a little bit difficult because we live in this. Craig, you have some thoughts about this?
Yeah, it's interesting, and I think Dan, you were kind of mentioning this is what are the major employment industries in some of these states? Michigan being manufacturing, we know what the wash tub is, right, and politics and government and stuff. Nevada, what is Nevada? Gaming, gambling?
It was gaming. Yep.
In California, there's a lot of agriculture out there, right? So, but it does show up in some heavy concentration in states for certain industries that unemployment's really high, unfortunately higher.
Yeah, wasn't Walmart the largest employer in the vast majority of the states, Dan?
Yeah, I think Walmart was about 50% of the country as the number one employer. I think Washington and Michigan were the only two that were manufacturing based. Most of the rest were healthcare, university systems, or in Nevada's case, gambling.
Yeah, and we're talking about Washington State with a little plane manufacturing going on there for now, at least. So definitely some changing things. And I think here, more than anything to take from this, is it is changing. We're seeing unemployment rise. Does it rise exponentially and cause problems becomes the question, where some people are going to lean toward AI causing unemployment. Others are going to say it's not causing unemployment. And I think that's going to be one of the big things we need to see play out. But with that, this is one of the charts that is a little bit tough to swallow here, is the leading economic indicators. They've been continuing to decline and this downward slope for quite some time now. And historically, anytime the leading economic indicators have been this far spread apart from their standard number to the blue, the current number, that's where we actually have seen recessions take place. So hasn't happened every time, but it's a pretty good indicator. Long ways to come down, right? All right, the fourth indicator here is credit spreads. Now, Craig's going to have some documents talk about credit spreads on bonds. I decided to take a little bit of opportunity to talk about credit spreads as credit losses in what we see as our industry. And we definitely are seeing some difficult things. Auto loans are now a higher level of delinquency than they were in 2010. That's something I know that's troubling for a lot of people on the call here today. Credit cards were not quite as high as 2010, but we're up at 12.25%. That's a big number. Obviously, no one's delinquent on their home loans or home equities because there's equity in homes. But we are also seeing the NASA combination turn into SpaceX. We saw the student loans drop to zero and flatline, and then now SpaceX shooting for the stars. But a 10% delinquency rate doesn't bother me that much, but it is starting to take payments from people and cause tighter ability to make payments. So it's definitely something to keep an eye on there. All right. With that, Craig, the inflation world, it's still too high to make you perfectly happy, but it's been coming down in the big picture, bouncing a little bit. Is that a dead cat bounce? What's happening here?
Yeah, it looks like the trend has been coming down for us in reality. Even if we take out the spikes that we saw after our pandemic numbers, where it shot up to darn near 10%, right? And if we kind of do a long-term range, we still see a slow, steady come down on inflation, and I think that's really important. I love that you ask about this. Is the balance between a dual mandate for the Federal Open Market Committee is unemployment and inflation, right? Employment. And they're outweighing employment right now over inflation because inflation still is a little bit higher than their long-term target. And that could be a big debate on itself, is should that target be changed?
Well, if I don't have a job to pay for the expensive items, it doesn't really matter what the cost of the items are. It might be a sarcastic side to add to that, but yeah, no, it's an interesting point. What is the right level of inflation? And given the debt level, which has become a political thing, which I don't think should be political, all political parties have been overspending. Higher inflation helps devalue the debt, although that devalues everything for all of us. So definitely a difficult spot. Speaking of devaluations here, we looked at this chart. We all saw different things. Dan, you saw Flag, I believe it was. Craig, you saw Alfred Hitchcock. Is that correct?
Alfred Hitchcock up there looking just to the left of Minnesota, I think it is.
Yep. Yeah, it was an interesting picture there, just off the UP, I guess. But what this chart is the states where unemployment or home values are dropping. So the blue states have home values declining. The invisible states have home values that are stable or rising. So we are seeing this trend a little bit with home values are starting to decline and have been declining in areas where there's been lots of home building versus areas there's not been a lot of home building. So the Midwest, there's not been a lot of home building, but there's also a lot of movement right now because of how low interest rates were and home values, how much lower they were. It's very unaffordable for people to move. So that's made it very difficult. We are seeing here, obviously, very elevated housing prices, especially if you think back to 2008-9. We couldn't believe how expensive they were. We're obviously much, much farther past that. But we appear to be taking hopefully a little bit of a break in price appreciation, which would help mobility at some point. All right. Well, with that, we're going to hop over to asset liability management, talk about a couple things here, and CECL, and we'll continue through our fun stuff here. A lot of data here. I think what share with this is we are continuing to see deposits grow a little bit, and we're seeing loans stabilize. But we're continuing to see the yield on loans come up a little bit. Loans on yield on investments have been coming up. Some people have got them already repriced fully to the market rates. But we're also seeing cost of funds start to come down a little bit. So a lot of forward projections are showing increased net interest margin and a flat loan to deposit ratio right now. So definitely interesting spot that we're seeing here. But this is really, to me, Dan, the loan growth here is definitely still positive and balances are increasing a little. When you work with valuations with clients, are you seeing anything different, or what are you seeing out there?
Yeah, I mean, from a value perspective, I think we're seeing portfolios get closer to kind of what we consider market yields. We've also seen kind of in the M&A arena, people going and targeting commercial lending areas or looking to, if they're not in the mortgage business already, get into that business as rates come down and we have potential for more refi. So, a lot of different things happening kind of all at once. But I think the main theme is kind of lower growth moving forward, is the expectation.
A little bit lower growth, and I think it's interesting as you think about the valuation too. When we do merger valuations or transaction purchase accounting, you used to get a big bump up for the higher yield in loans, but as loan rates get closer and closer, it's going to hurt that income standpoint there, or reduce the amount of additional income. Which a great example show here is that loan yields have been rising. We're showing all banks in the country greater than $1 billion, less than $1 billion of assets, pretty much the same yields right now. We did see them come down just a little bit this last quarter, but not a huge modification yet, but we're definitely getting everyone closer to market yields on loans today. All right, Craig, deposits are really kicking back into their growth pattern. It's really interesting here. We obviously have the big pandemic dollars that came in there that spiked up our deposits, but what are you seeing out there with deposits at our clients out there and the results of that?
Yeah, so for the last how many quarters would it be? Maybe 4 or 5 quarters, we've seen a little bit of trend in deposit growth happening. Not at an unmanageable and unexpected pace, but the last actually quarter, like we looked at September numbers and they were up a little bit, but since September, we've seen some flattening now actually. And it hasn't been tremendous. People aren't worried, but we want to make sure that as we go down and if interest rates are pointed down as a result of what some are thinking is going to be a really slower economy, that usually drives a little bit of excess liquidity in the marketplace. So we're not going to expect these deposits to trend back down in reversal, but we are starting to see them go flat right now.
It's so interesting. I love the conversations we have as you're looking at weekly data and daily data, talking with our advisors and talking with clients. And we look at data coming through 9/30, we saw some decent deposit growth, but it's not across the board. I agree with you. And then seeing what people are talking about this last 4 weeks, definitely seeing the same data. And it's really interesting to see those balances start to flatten out, if even come down a little bit.
Yeah, we've had seeing a lot of CD specials also being at the peak of rolling off of balance sheets right now. And a lot of the clients, a lot of advice has been to, bring those deposit rates down a little bit unless you have that real need for the liquidity on your balance sheet. So the most have been decreasing those CD rates. And so we're expecting a little bit better margins, as you had mentioned before, continuing to grow.
Yeah, it's very interesting looking at a lot of the ALM reports that are heading out of our office here every day. It's definitely seeing CD balances decline and money market checking accounts, saving accounts up or flat, but a bit of a shift there. And this chart really highlights it. Again, this is bank data showing below $1 billion and above $1 billion. We have seen in the last couple quarters now, 1, 2, 3 quarters, effectively rates down just a little bit. And we're not huge numbers here, but I think it's really important, as you said there, Craig, to think about what your specials are if you're doing specials and your goal of this, because one of the things that I worry about is in the future, and I know this is a bit of a funny graph here, but what I worry about is interest rates where we are today in earnings and equity, earnings at risk and equity value, EAR and NEVE. If rates would go up or down a couple hundred basis points, it's not a big deal. But once we start to get down, 250, 300 basis points, we really floor out in our cost of funds and we start to see margin compression. So making sure that we're moving quickly to reduce our cost of funds to plan for this potential continuation of declining interest rates is something we should all be very thoughtful about right now. We really want to make sure we're thinking about that -200, -300, wherever it is you floor out. Everyone out there is going to be unique in where that flooring is going to happen. Dan, Craig, anything you want to add to that?
No, it's a valid concern in reality, and it's going to go down to balance sheet management, really. And we'll talk a little bit more about that with the investment portfolio, and we're helping to offset some of this risks that are inherently on some balance sheets.
Yeah, definitely. All right, with that, Cecil, always got to stop in Cecil for a quick minute, and we are seeing it. Most of our clients are Cecil numbers are flat, not a big modification yet. We do see some markets rising. They seem to be more pockets markets and unique situations. But we have had a number of people tell us that their collections volume is up. Their effort getting collections or spending is a lot more today than it was a few years ago. And frankly, there should be some normalization from the super low levels to normal. We just don't know if they're much more elevated, because when we look at that national delinquency numbers, it looks pretty bad. But we look at our individual clients and all of your financials, we don't see that big of an increase.
Right. It really is based on the lending program that everybody has and how they are actually putting their credits on. And that credit cycle that you talked about spreads and showed all those delinquencies spiking so much is very representative of nationally. So be smart in the lending program there.
Yeah, this might be the day to not make the marginal loan. Just a thought out there for everyone.
Mhm.
With that, just a quick sidebar, then we're hopping into the investment section. We are updating our CECL model for 12/31. We're really excited about it, with different sets of look-back terms and look-back term selections, some different ways of doing economic projections, and some improved report delivery and individually evaluated loan input. So a lot of big updates happening there. Really excited to have our team working very hard on that. All right, with that, Craig, we've got some great investment activity going on out there in this world.
We do actually. So kind of going back to the yield curve, we had a long-term yield curve, and here's today's yield curve, just looking back versus a decade or so ago. And you can see how the curve right now is relatively positively sloped, right? With the exception of that really short-term cash side, which, typically is a good for industry, good for our clients, good for banking and credit unions. And it's pointing towards hopefully what we think is not a soft landing. We can't use that term anymore because we're way past that. But maybe some little bit of hiccups in the economy that doesn't lead to a recession. But this is why we're staying at this positively sloped yield curve. We're kind of liking that. As we kind of look at it, where you pick your point out on your balance sheet and where the yields are is super important for proper portfolio management. There we go.
Sorry about that.
It's all good. So, and as you look at, what we really need is to have somebody have an AI agent changing the channels, right, or the pages.
It would be much better than me, apparently. You're the
Right.
Woody. You're the Woody Harrelson, and I'm not.
Oh, that's funny. So, current yields. 10-year is really a good indicator of where things are going. And you mentioned mortgage market, Dan, you talked about home prices around the country. And as you can see, this 10-year tracking back down, which it is hovering around that 4%. I did lose a bet, on this whole 4% floor, but it's really going to change what's going on because the mortgage market is one of the largest lending groups in the country. And those lower rates are going to help drive more refinances, which means income, right? And then if it continues to trend down, it could start to cause a little bit of mobility as well. Everybody does have really low mortgage rates, and they have a lot of equity. They might not want to change up to a new tax base. So they might have to do some 1031 exchanges and whatnot. But it's going to really be positive, I think, for the economy. And I think there's a few people in Washington is trying to push this as well as, have a little bit, right? The lower interest rates.
Maybe 1, 2, but yeah.
Exactly. Still a great curve though, or still a great yield, I think, overall.
Yep. No, it is. I always wonder, are we going to see a Fed start buying down 10-year treasuries again like they did in the past, which would be an interesting spot. So definitely an interesting world we live in. But speaking of an interesting world, it's hard to say we're struggling in a world where the stock market only goes up.
Yeah, I love the way you introduced this chart because we've already looked at the equity value of people who are owners in the United States is really high, all-time highs, even if there's a little bit of softness in some markets on homes. Now you can overlap that or combine it with the stock market wealth out there with for brokerage accounts, 401ks, IRAs, all of that. There's a lot of wealth, never been higher in our country right now, which is kind of offsetting a little bit of what's truly maybe going on in certain sectors, right? And that's one thing that's really different than prior interest rate cycles of how much wealth is out there right now.
Yeah, and we always talk a lot about the number of people or the percentage of people that are participating in the stock market. And while I was sitting with my daughter last night with her and her green light card, it popped up, do you want to invest today? And it gave the 8 most used stocks, which included NVIDIA, Microsoft, Amazon, and a couple others that you'll know the name. So there are more people getting involved in the stock market every day, which is great when you think of things like that.
Educating them early. I love that. This is an interesting chart. So we talked a little bit about the credit spreads, and now this has to do with average credit across the spectrum of credit default swaps. And it's basically financial bets of something that's going to default. And when the chart is low, as you kind of see, has been trending down since, is that 2022? I don't have my glasses on. It's been coming down since 2022. Charlie, I know you don't have yours on either.
Nope, it's
That is-
2022. Yes, September of 2022. Dan's going to tell you.
Yeah.
Thank you for
Yep.
helping a couple old guys, Dan. Appreciate that.
Anytime.
But the overall trend is down, right? So the credit spreads are very low. So if you want to buy insurance protection on something defaulting, it's really cheap right now, which means most people feel there aren't going to be major corporate defaults going on. The income is healthy, balance sheet's healthy, outlook is healthy. And, once again, it is ticking up in the ultra short term over the last couple of months. But as you do see some spikes, it typically happens in times of turbulence, time of recession. And so we're kind of watching the short term, even though we are very much a long-term play, a company, but watching that short term and making sure that it's not leading some other more problematic things in the economy.
Yeah, definitely interesting when you hear about bankruptcies high and corporate bankruptcies, but credit default spreads are still low, and in the big picture, bankruptcies are still low. So we hear of the one-off things, but it's not the whole market right now. So it's easy to lean that way. And then you prove the point here again too in this slide, which is really interesting.
Yeah. So if you apply that credit default swap philosophy of, hey, things are looking good and people don't think that people are going to be defaulting, you can look at this, which is the actual spread for a high yield investment. So high yield, not even investment grade, and over the spread over a riskless treasury, and see how it's been really trending down since the Great Recession there, or not the Great Recession. Well, yeah, the Great Recession, both of them, but it is at ultra low levels right now. And that we'll talk a little bit more of, hey, is it the highest yield, and is there really value there, which are two different things altogether. But spreads are really tight, and it's kind of unusual to me of how tight they are right now. But I think it has a lot to do with how much liquidity is in investment portfolios. You mentioned 7 trillion in money market funds and how much money is on the sidelines. But spreads are really tight right now. People are thinking really optimistic on credit right now.
So again, what this chart is showing is that you don't have to get a lot of additional pay. You don't have to pay people additional money for taking risk. And that is very just counterintuitive to watching 50% of the news channels today. You'd think that there's much more risk out there. So definitely an interesting spot. And this highlights it too. When you start to look at the differences in these curves, there's not a lot of space between these curves at all, is there?
No, everything is very tight. Really pretty too, by the way. Good job, Dan and Charlie, on putting this together. I appreciate that. Might be a different month to throw out all these colors, but the very top curve is corporates, what we just talked about. And they're really tight right now from a spread standpoint, even though of the most common asset classes that we're looking at here is corporates, taxable munis, agencies, treasuries. The low chart is the bank qualified munis. They're even though it's the highest yield, we're not really getting paid a lot of benefit. That risk-adjusted beta is not there for corporates, even though it is the highest yielding. So you have to be careful, depending on their balance sheet, whether we need to keep adding into that corporate world. And the other thing I just want to point out is, Dan, you mentioned this earlier, and I loved it, is some of that loan growth is from institutions starting to get into commercial lending as well. So if you're starting to get into more and more there, maybe you want to back off if you're playing in the corporate world, where you're going to take corporate risk on both sides of your earning asset sides there. So just kind of be careful there.
So you're not getting paid for taking a lot of risk, which is an interesting spot to think about there.
Well said.
All right.
So I also wanted to talk a little bit about traditional strategies that are out there, and it ultimately, regardless of your strategy, you always want to kind of take that SLY principle: safety, liquidity, then yield in priority order. A lot of important things to think about that most traditional portfolio ladder, and that what that does is for institutions is building expected cash flows, and key on expected cash flows, because if we do have a liquidity event, we'll have those cash flows coming back to people and to your portfolios for lending, for withdrawals, for whatever happens within your markets and your institution. The other thing really is key is duration management in your investment portfolio, and how it really complements the duration of your liabilities and your lending portfolio. So you really want to make sure that your investments are purchased with very deliberate intention on what the duration is and what it could be if interest rates were changed. Filling in some barbells, if you've had that barbell strategy over time, you might not want to do it quite as much, depend on an interest rate cycle, maybe filling it in a little bit. Then always think about pledging. If we do have a liquidity event, what is your contingency plan? Do you have enough securities to pledge for lines that are out there? But ultimately, that duration is important, building your cash flows that are expected. And talking about just some thoughts on that, and the next slide there, Al, I'm going to call you Al instead of AI, is the portfolio management. One thing I didn't talk about is diversification. And as we do see the different asset classes provide more value than others, it's almost like everybody flocks to it, right? And you got to kind of pay attention to make sure you're diversified across issuers, across industries, across sectors. So you're not necessarily harmed too much with respect to if one area goes down. Good example is in municipals. A lot of people will stick to local issuers. If you have a little local recession or something happening, you want to be diversified across a lot of different areas. The other thing in diversification also is maturity range. Going back to that ladder, you want to be diverse on what you're buying, and you make sure you have those ladders. So stay across that as well. And then last thing is diverse across when you're buying. Don't buy everything all at once. Buy over a period of time. That old theory of dollar cost averaging, if you will.
Yep.
Yeah.
It's interesting. I really appreciate your comments on duration. We both have different opinions on how much the Fed's going to move rates down, but we're both talking about Fed going down. And we start talking about for how long? Is it a 5-year time frame, 3 years, 7? There's a lot of different variation there. But the one thing we want to do is make sure that if we can avoid repricing our securities for the next probably 3 to 4 years, it's a good thing. I think we can all agree to that. And so I think that's a good idea, to be prepared for that, and that not buying calls and having the right duration is really, really important.
Absolutely.
Yeah.
We did talk about wealth creation in the real estate market and the stock market. I just wanted to touch base on a few things. Everybody on our call are involved in some way, shape, or form, whether you're a bank or credit union, through your foundations, either whether you're invested in them, whether you're giving to them, whether you're volunteering them, whether you're on a board or something. We're creating a lot of a wealth creation through our foundation asset management through McQueen Charitable Solutions. So keep us involved. Keep us in mind if you need help or questions, whether setting one up, whether managing one, whether you need some help on the investment side. The other thing interesting for our banking friends that are on the call is that don't forget about your holding company. What is typically your major asset of the holding company is the bank, but we also have other liquidity that's up there, and what are you doing with it? So we do manage a lot of portfolios for bank holding companies. Has a different investment policy than your bank. You can get a little bit more, I don't want to say risky, but you can become a little bit more, what's the right word? Diverse on your selections of what you'd be investing in at the holding company level. On our credit union friends that are on the call, we also have the charitable donation accounts. Again, doesn't matter who you are, you are here for a reason to be supporting the community, supporting what you guys believe in, and you can increase your earnings. We're creating a lot of extra earnings and wealth, helping out all of the charities and foundations that people want to give to, which is really cool. And then also we just are, Charlie, we're right through it right now in the heat of going through our benefits for 2026. And we've got a major increase, and this employee benefit account with enhanced earnings can help offset those increases. And I know everybody on the phone is probably, if you haven't received it, you should have already received what your renewals look like. So don't forget about the EBPAs that help offset those increased expenses.
Yeah, the renewals are going to be ugly for everyone this year. Typical plans 10 to 15%. If you're in any of the Affordable Care Act ones, are 20 to 50%. Just big increases. So thank you, Craig. I really appreciate highlighting that. A couple quick questions I'd like to just quickly take right now. We have someone asking about they have a corporate account paying a high yield right now, which is going to go away, or an overnight funds account paying a high yield. They're worried about it going away. Should they buy, what should they buy? Should they buy bonds or mortgage-backed securities? And one is be very careful. While there are some very good mortgage-backed securities out there, we're buying mortgage-backed securities today. I also don't want optionality. I'd rather see a fixed term than optionality, because I don't want that money coming back if refinances hit into lower yields. So definitely, I'd stay in a general picture. I'd say stay away from mortgage-backed securities. There are good ones though, so I don't want to just say a perfect absolutely no, but I'd lean away from them. Second question is really interesting here. We have some big cap expenditures coming up this next year. What's the best approach to borrow to cover them or let investments run off? And my recommendation here really goes back to thinking about the correct way and how we use our balance sheet to do things. I'd rather see you keep your balance sheet higher because expectations lower interest rates. So buy the investments, put the investments on the books, borrow some money to pay off then use that to pay off the capital expenditures. We can use the higher earnings of the investment portfolio to pay off those capital expenditures over a period of time. Because if you go out and buy a new building, new chair, new computer, technology, you're going to get many years worth of value over it. And I'd rather see you use your balance sheet's typical standard leverage to cover those expenses.
Yeah, and on those borrowings for those CapEx, that I liked your statement there on the shorter term, because if everybody is right and rates continue to get down, liquidity will be coming a little bit more easily available, and you'll be able to just pay off your borrowings and in the short term. Yeah, because liquidity should come an increase for you
At a lower cost. So really good.
right on. Yeah.
All right, Dan, you've been remarkably quiet. But time to hear all sorts of stuff about what's going on in this world.
Yeah, so we should have some good items to share. I think the first piece I just want to hit on is, before we go through kind of what we're seeing in the banking world, but talk about branch transactions. So this is kind of applicable to both banks and credit unions, but we've seen a pretty good uptick in branch deals this year. Really the most we've seen in probably the last 3 or 4 years. A lot of that's going to come in really the most recent quarter, as we'll see on kind of our bank slide here. We've had a lot of activity. It's kind of ramped up over the course of the year. This is something I expect to continue, especially with some of the larger consolidation deals that have been announced in the last 60 days. I think we're going to have a lot of spin-off activity that people are going to be able to take advantage of.
Yeah, definitely a lot of stuff going on there.
Yeah, this is another interesting one. Really looking at this on a quarterly basis, we're kind of at a bit of a lull for branch closings. So if you think about it historically, a lot of these closings have been derived from like grocery store locations or, maybe non-typical retail locations that have been closing as people reconfigure what makes sense for a branch footprint or your branching structure. It's interesting. We've seen less the retail or the kind of unique grocery store type examples that has declined significantly as far as closures. I think we've kind of come to maybe a full amount of those closures in the market. Everyone that's kept them to date is likely going to keep them in the near future. Obviously, there's one-off occasions, but I think that's kind of what we're seeing here is the full realization of people disposing of those assets.
Yeah, definitely interesting. Some big numbers back in 2023 and definitely slow, but I do expect with some of the bank transactions announced that'll kick up. And but speaking of transactions, there's quite a bit of credit union merger activity taking place.
Yeah, I think this is something I expect to continue. Previously we've seen a lot of credit union merger activity and even bank merger activity where we're seeing larger institutions merge in smaller institutions. It's becoming more last year and really this year, we're seeing a lot of larger institutions do deals. So that's something I expect to continue as people continue to go for economies of scale, get lending talent, people talent, and enter new geographies.
Yeah, it's interesting. The number of transactions is down, effectively by a third so far this year. We're about 40 a quarter, and that's turned down quite a bit here, which is interesting. As the numbers get smaller and smaller, it's tougher to find those mergers. And where are you seeing most of the mergers take place, Dan?
Yeah, well, so I think it's really notable that most of the mergers are taking place in states that have high concentrations of institutions, right? So Minnesota, Illinois, Texas, California likely be a little bit shade darker going forward, but Georgia, Florida, Pennsylvania on the East Coast there. Really those states with the highest concentration is where we're seeing the most activity, which makes sense.
Yeah, that combined with a lot of baby boomers retiring pretty soon, I do expect there will be an uptick in all those areas and across the board with banks and credit unions, obviously, is ever aging population. But the credit union bank deal or U.S. bank deals announced here. This is an interesting data set here, Dan. The numbers way down, but the blue bar is way up. I'm confused.
Yeah, so it's interesting. In January of this year, I went and saw the new FDIC chair go and speak, and he talked about opening up and making it easier to do transactions. So I think, we're kind of seeing the revelation of that as it trickled down through the regulatory agency in Q3 and Q4. A lot of those conversations kick off in Q1 and Q2. So we're kind of seeing that take place. Now, obviously, the number of deals is significantly lower, but I think that really opened up discussions with a lot of those larger players to go and look at what might make the most sense.
Yeah, definitely a big uptick in numbers through quarter three, quarter four. Obviously, we're just getting into it, so it is low, but I expect we'll have some big numbers there and really kick up to fall in line with that. But that is the big volume, obviously, with the Comerica deal announced there, Comerica Fifth Third. But it's trending in an upward path right now. Well, now going into a different spot, spot here that's a unique activity, but credit union bank purchases. What's going on in that market, and what do you see in the future, Dan?
Yeah, so I think this is obviously still a very small portion of the total bank market. That being said, I mean, we've kind of been on an upward trajectory since 2017. You kind of have a banner year and then you have a little bit of a lull year followed by a banner year the last couple of years. So I would expect, maybe this year we finish out 15, 16 transactions. By the end of 2025, next year, I'd probably expect something closer to 2024 numbers or more as we get a little bit more into that regulatory swing of kind of loosened guidance.
Yep. And we'll talk more about regulatory guidance in a little, but what's going on in the capital world?
Yeah, so I think this has been a big stressor for a lot of institutions looking at M&A activity is, in the credit union bank purchase area, do you have the capital to support these transactions? So what a lot of regulator feedback has been is, get your capital ready to go, get it set prior to engaging in this activity. So that could mean looking at sale leaseback activity to boost your capital. That could be, raising subordinated debt to raise your capital, or it could be, adjusting the structure of your balance sheet, selling off loan pools to kind of manage the size of your balance sheet and your ratios there. So a lot of different things you can do. Not really a one size fit all application to everybody, but certainly something we can help anyone explore.
Yeah, definitely getting some changes happening also with the yields coming down. that'll hopefully get rid of some of those unrealized losses that are persistent in some portfolios too.
Yeah, so on that in 25, really what we've seen, mentioned the focus on capital. We've seen a big uptick in incentives for people. So whether that's buyout contracts, change of control agreements, those have kind of taken off, and I think that's probably going to be something we continue to see. And then the regulatory timeline I mentioned on the bank side, the FDIC has been moving at a very fast pace the last couple quarters. NCUA is a little bit behind that, but I expect both of them to kind of expedite their timelines as we roll into 2026, which again leads to probably more M&A than we saw in 25.
Yeah, so definitely a ramp up, hopefully with obviously a lot of changes happening in Washington and a lot of retirements, and that makes it tough. But as the new people get educated and catch up, they're there. So last couple words you have here, Dan?
Yeah, so I think anyone that's looking at this activity, number one, you got to start with your balance sheet, right? So appropriate investment management, appropriate risk management on that to really make sure you're optimizing your earnings, you have ample liquidity, that sort of thing, to really get you prepared to look at mergers and acquisitions. I think then step two, kind of on the credit union side, EBPA, CDA, those are great tools to use as incentives for mergers and acquisitions. And then kind of once you have that baseline established and you're kind of ready to look at it, really defining those goals, coming up with your strategic plan, how do you want to grow? Do you want to buy a lending team? Do you want to get into a new geography? Define what that looks like, and then finally take action, whether that's, having us help you plan that activity, having us help you go out and execute that activity, whatever that may mean.
Yep. Well, thank you, Dan. I appreciate that. It's a definitely great planned process, something we should take time to plan to do correctly. With that, we're going to wrap up with 7 points here for everyone to take home and think about. And with that, 2026 projections, Fed, we obviously October 29th, they're done. They went down a quarter. I think down a quarter in December, quarter in January, March, and May, which gets us down to 3%. Craig, you're a little bit different. You're expecting this to be a little bit closer to 3.5%. Is that correct? Well, he's new to video conferences, video calls here. He doesn't know the mute button, right? We've only been doing this for 10 years.
Yeah, right. So yeah, I just think it might be a little bit lighter, just with all the positive things, the wealth, the money, the creation that's out there in businesses. And yeah, there's a lot of layoffs going on right now, but I think there might be some stabilization in 2026. So, somewhere around 3.5. So I wouldn't be surprised if it was 3. So, but somewhere where I think the trend is it's going down.
Yep.
Yeah.
I think just if we prepare for down 100, it's down 50, is not as bad for us.
Yeah, right on.
So our interest rate projections are here. I'm not going to read through them. Everyone can look at those, and we'll happily send out a copy of this. I won because I got the last slide to put in, so I put my projection in versus Craig. So it was kind of fun there. He didn't know that. Just staring at the screen like, wait a minute, that's not my number. But I do think that one thing that really was shocking to me, as you pointed out, GDP and CPI. GDP came in amazingly strong. Even though I don't know, did we get real government numbers or are they fake government numbers?
Yeah, right. I think they're fake ones.
Yeah.
But what I did find really interesting compared to what we were thinking, and the Fed's outlook on GDP was, I think it was only like a 1.6 as a total for 2026.
Yeah, it was below 2%. I remember that. It might have been 1.8 or something, but it was below
Yeah,
2.
very
really
low.
small.
So if that comes to fruition, we're going to definitely see that 3% handle on, or even maybe a 2 handle on Fed funds. To be honest with you, we'll have to see what happens there.
But third quarter GDP was 3.8, and you pointed it out to me. I just couldn't believe it. I trust it. I was shocked by how big that number was. Just incredible. So, a lot to come there. We'll see what happens. Point 3, looking at loan projections for 2026. It's a mixed bag. I'll be honest with you. It depends on who you ask and where you are, and how you're lending, what industry you're lending in, or what types of industries. As Dan, you pointed out, was it commercial was strong for a lot of people?
Mm-hmm. Yep.
But auto, we're looking at, sub 17 million cars next year, some of the predictions we're getting from Kelly right now. So it's interesting. Quality's key, yields flat to lower, what we expect going forward. Delinquencies and losses most likely increasing. Not to hit the alarm bells, but back to more of the normal levels is what we expect at this point. But it's going to be tough to grow loans. So be cautious with that. It's keep your credit standards in place. And if you don't grow as much as you want, that's okay. We shouldn't be overly panicked about that. Anything you guys want to add to point number 3? All right. We're off to point number 4 then. Speak now or forever hold your peace, right? 2026 projections here, investment growth. Craig, what do you see happening here?
So I think with a little bit of a slowdown that is expected in the economy, we're going to see a shift from lending a little bit more in the investment side of a little bit of portfolio growth, somewhere in 5 to 15%. It's critical. We've played this game, especially us old guys have played this game a lot, is make sure you properly build that portfolio which can weather the storm of what's on the backside of this economic cycle, which is rising interest rates. So Charlie, you mentioned that earlier, watch your duration. It's okay to extend right now. We're not talking now to 20 years, but you're talking 3 to 5 years. At the end of this cycle, shorten that up some. Make sure you stay in good credits, right?
Yeah.
Super important. You don't want to be chasing those credits out there, especially when you get into subordinated credits. Just be really, really careful if you're playing in that space, because if we do have this continued deterioration. Oh, and one thing we didn't talk about is commercial office space, right?
Yeah.
That's all-time record high in delinquencies on commercial, non-owner occupied stuff. Not that all of our clients are doing that, but you could have exposure through some asset backs, some REITs, some different type of stuff.
Yeah, CMBS delinquencies at record high, and those are usually the very, very large office buildings. Not a typical thing that community financial institutions are investing in, but definitely a concern. Be careful with cash. I don't want to have too much cash out there, because we have too much cash. We come into this, it does hurt our earnings because that yield comes down. All right, Dan, we're seeing deposits up a bit. As Craig said, that was last quarter through the end of the quarter, but this last 30 days, we're seeing them pretty flat. But that may be more of a modification of reducing CDs and growing checking accounts, money market accounts. Anything else you guys think we should mention on this?
No, I think that kind of hits it. I think you're going to have some CDs roll off, and as long as you're adjusting your rate appropriately, you can keep them on there if you need the liquidity.
Perfect. I do think it's going to really helpfully speed the reduction of that cost of funds fairly quickly, which then point 6, it will help our margin. If we see our asset yields a little bit higher, investments getting on the books a little higher, we have loans going up just a little bit more still, and our liability costs starting to come down now for a quarter or two, that is going to propel margins and propel our forward profitability. So I'm excited about that. And but make sure you're also hold your own on your loan yields. Don't fight to get loans in the books, especially if they're marginal. And then your cost of funds, make sure you're cutting them. Don't be afraid of cutting them, because especially at the rest of the world, and we're not talking collusion level here, but big picture, people are really cutting those costs of funds. It's the right time for you to think about cutting the cost of funds. All right, in the point 7 here, the valuation space, Dan, what would you like to close out on?
Yeah, I think we'll see volume up, we'll see transactions up, we'll see bigger deals announced. I think we're going to see vast improvements in the regulatory environment, and then as rates come down, we're going to see valuations on the investment portfolio and the loan portfolios improve as a function of purchase accounting, which again, it's just going to encourage more people to look at transactions. So I think we're going to be up all across the board. The biggest thing is just making sure you're ready to take advantage of situations as they present themselves.
Yeah, I think, Dan, that's a great spot to end on, because the best way to be prepared for a potential M&A or transaction or merger, whatever it may be, is making sure that you have good earnings and strong capital, and having a good plan to be there and be a strong institution. That's where you win the game of growing from a transaction standpoint. So with that, I'd like to thank the 3 of you for joining me today on our annual conversation here and getting ready for 2026. We do have some different viewpoints, but we do all feel the same way that interest rates are coming down. Just how much, and that might not be the longest downturn of interest rates. So a lot of uncertainty out there, but we should be prepared for rates to continue to come down, deposit rates come down, loan rates be a bit flatter, but a little more difficult to get loans, and the potential for a little bit of a slowdown. With that, Craig, anything else you'd like to add to the comments?
No, just appreciate everybody joining us today. A lot of great insights. And if you do have some follow-up questions, please reach out to your advisor. We'll always make ourselves available for you guys to help maximize your earnings and your stability of your institution and prosper.
Dan, anything you'd like to add?
That was a great closing statement, Craig. Appreciate everyone for joining, and feel free to reach out if you want to know anything more about M&A or anything we discussed today.
Thank you all. Appreciate the time you spent with us. And just to wrap up here, our next webinar will be a State of the Industry M&A update coming up on December 9th. We're going to do a very focused conversation about transactions, valuations of transactions, and transaction projections for 2026. So with that, thank you all very, very much for being here today. We appreciate the relationship. We appreciate the continued support of all of us here at McQueen Financial, and have a wonderful rest of your day.